Good morning, ladies and gentlemen, and welcome to the Diverse Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet company platform. Before we begin, we would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Claire Long, Head of Investment Trust at Premier Miton. Claire, good morning.
Thank you, Jake, and good morning, everybody. Thank you for joining us. I won't stay with you long. Just really to introduce Gervase Williams, who manages together with Martin Turner the Diverse Income Trust. This is the second presentation that we've given on this platform, and very interesting to hear what Gervase has got to say today. And we very much welcome questions, which we'll answer at the end. Thank you, Gervase.
Thank you very much, and thank you very much for listening in. And what an interesting time it is to be talking about not just the Diverse Income Trust, but the equity market, particularly the UK equity market at the moment, particularly with the introduction of the global puppet master, Trump. He invokes change, and one of the effects of change is that actually the status quo as we know it has moved on, and actually, interestingly enough, UK equities are starting to have fall. This is an important slide. Obviously, everything involves ups and downs. Don't forget that. Just to start, Premier Miton, you may have noticed we've got a slightly different branding now. We've got that little kind of bit which looks to be missing from Premier Miton, which is a blank sheet of paper. And what we're really just saying is there's lots of fund management groups out there. The opportunity really isn't just to add value. The opportunity is actually do something where we can actually excel, work towards our individual strengths, be different from others. I hope that we are in general. I hope we are in this trust. But specifically, it's a matter really about starting with a clean sheet of paper, which gives us the widest opportunity of investment, which ultimately, hopefully, will give better client outcomes. What I thought I'd really start with in terms of this trust was actually just remind everyone that the whole point about this trust isn't just that it's an equity income fund, not just a fund which is investing in the UK market, which has plenty of equity income stocks, but most particularly, it's a very broad market. We've got very large numbers of companies which are mainstream companies, but we've got mid caps, small caps, and of course the AIM market. And if you remember, the long term, the smaller the company, the better return. And this is data from 1955. And as you know, it isn't just that small companies have a premium return, but over time, as that compounds up, it becomes a very, very substantially better return than the mainstream stocks. So the opportunity is not just to invest in small caps. We invest in mainstream companies as well. It's a diversified portfolio, but the outcome is hopefully we get not just a better income, more consistent, better growth, but actually a better total return as well. And so when you look at the trust, you think, well, fine, but necessarily it hasn't done a lot in the last 5 years. You know, what's been going on? And in a way, it has been fine over recent years. It's just that people look at capital growth, particularly. It's a very dominant feature for measuring returns and performance. But actually, it doesn't always tell the whole story. The whole point about a trust like this isn't just that it just generates a good income over time, but most particularly that income is good and growing. We've been through something of a stress test in 2020 with COVID. This trust didn't just maintain its dividend, it grew its dividend even as revenue per share fell. But subsequently, we've seen a strong growth in revenue per share, particularly over the last 5 years. And that's, although that's happened, that hasn't necessarily been reflected in capital growth at this stage. So what we think is actually interesting about the world out there is, yes, you make returns from capital growth. If you look over the last period since this trust was set up in 2011, you can see actually the dominant part of return globally, the FTSE World Index, has come from capital appreciation. The light blue area is related to income accumulation, but capital growth has been absolutely an enormous feature, particularly during globalization. This Goldilocks years, market economics have been generally not too hot, not too cold. It's been a very, very good year to generate a very good long period to generate returns. And the UK market's just different. It doesn't mean it's bad. It's just more dominated by good and growing income stocks. And actually, if anything, people have taken money out of the UK to put it into perhaps the Magnificent Seven in the US. And that has led to a reduction, perhaps, of the returns you would have expected from the UK, given its income growth, and actually an enhancement, perhaps, from the return of some of the US equities. And so you've got this very extraordinary differential between returns, which we think with Trump may be a subject to change. And when you look back over the history, this is looking back to the 1930s in decades. This is S&P index returns and the percentage of contribution generated by the good and growing income as opposed to capital appreciation. And although there was a period back in the 2000s when dot-coms during that particular period, 100% of the return of the S&P index was actually contributed by the income. The capital gain made no difference in that particular period. But what has been really a big feature, apart from that 10-year period over the last 50 years, has been how substantial the return capital appreciation has been. And if you look back prior to globalization, the 30s and the 50s and such like, what you can see is actually typically good and growing income dominates. It doesn't just generate a substantial part of the return. Sometimes it generates a very, very substantial part of the return. We think that we're going through a period of change. We think people have got very used to making capital gains. We think good and growing income is going to become more important. And specifically, this is S&P 500 data. That will happen to the US as well as the UK. But we think the UK is better positioned to meet this agenda for the future. And so when you look at the companies in the portfolio, what you notice is actually it isn't just that some certain stocks succeed, but sometimes when these companies generate a surplus cash, they get the opportunity to reinvest more rapidly. They can grow their business more rapidly. And although mainstream companies can appreciate by 1 or 2 or 3 times their share prices, perhaps over the long term, typically this happens a little bit more frequently amongst smaller quoted companies. They're more overlooked at valuation to start with. Perhaps they end a long period of investment and they start to generate not just surplus cash, but all the return on the prior investment. And that can really drive return. And so the reason we've kept this in is actually because in many cases, sometimes you don't just make a return, you make an exceptional return in small caps. That's not been so much the feature of the last 5 years. This is looking at the last 5 years. But actually, if you look forward, we think this is going to be a feature which is going to become more important. Again, we're going to see capital moving from mega caps into the mainstream companies, equity income stocks, and then ultimately into certain smaller companies, particularly equity income small caps. And so when you look at the portfolio as a whole, again, what you see is a very diverse range of companies. Many other equity income funds will be dominated by many of the very largest UK quoted companies. They've done well. They've grown their income nicely over recent years. They've actually outperformed small companies in the last 5 years. But most particularly, we don't just have to invest in them. What you can see here is mainstream companies, the supermarkets, maybe some of the insurance companies. But what you also see is the portfolio has also got a vast number of companies which are not so well known in the income world, companies which are generating income, good and growing income, but where perhaps as they've succeeded, their share prices appreciate. And that's why some of these companies are 2 or 3% of the portfolio, because actually their share price has gone up. So we have a fairly diverse range of holdings. There's just under 100 holdings in the portfolio, but specifically, we've got the success of these companies coming through. And if we do find that the small companies start to recover, if we do find the UK starts to outperform, then we think that this kind of strategy is superbly positioned to participate in that recovery. And so when you look at it, actually, it's not just that companies can succeed. Sometimes you can see that companies have been able to generate return year after year. This is a company which has been in the portfolio only the last 3 years, but it's obviously been quoted for many years. And you can see that if you bought it back in 2020, the share price has gone up something like 20 times. It wasn't producing income, but we were quick to spot it when it was producing an income 2 or 3 years ago. And although the share price has only come up 2 or 3 times since that time, we think what's amazing is these kinds of companies would have normally been on much higher valuations after the success it's had. With small companies being a little bit overlooked, with the UK being overlooked, what we've seen really is that even successful companies like this are standing on what we consider to be undervalued valuations. And as that normalizes, and of course the company hopefully will grow further from here, then we can see companies like you producing attractive returns, which boost the total return of the diverse income trust. So coming back to the change, we think there's major change going on. The last 2 or 3 decades have been dominated by globalization, Even 10 years ago, maybe 2015, 16, we saw the election of Trump, we saw Brexit, we've seen the electorate beginning to vote against globalization. More recently, we've seen certain European elections, which are now beginning to fragment from the middle, and we're beginning to see people demanding change there as well. And this is becoming more nationalistic, in some cases more protectionist. What that really means is that the patterns we've got used to for the last few decades probably are coming to an end. If anything, Trump and the way he's changing things is probably going to have a more significant effect than even many of the expectations have been prior to his arrival. So we're in this period of extraordinary change. Markets themselves haven't changed very much, but the directions, Goldilocks has come to an end. We're looking really at a much more unsettled world. And specifically, we think this is going to be very favorable for companies which have strong balance sheets, which will generate surplus cash. Many of the companies in the portfolio, they don't just survive. Some of them will be able to thrive even as some of their competitors become insolvent or forced to sell businesses at low prices. And so when you look back in the past, we've been there before in the UK. If you go back to the 60s and 70s and early 80s, we had lots of strike action. We had a fairly slowly growing economy. Specifically, the UK stock market itself, the All Share Index, as shown in this slightly lighter purple line at the bottom here, was one of the best performing stock markets in the world. It didn't just keep up with the US, it outperformed S&P 500. It was one of the best performing stock markets in the world. But equally, even in a time when actually the global economy was unsettled, the UK economy was not doing well, specifically sterling was quite weak, so international earnings of many of the majors was an advantage. Actually, you can see that light blue line, which reflects the bottom 10%, the smallest quoted companies, small quoted companies listed in London, didn't just keep up with the mainstream markets by buying acquisitions from the receiver, often for a nominal sum, and generating additional earnings growth. What you saw is not just that these companies kept up with the main market, they outperformed. So just to remind you, the bottom line, the FTSE All Share Index was one of the top performing markets in the world in this period. And the best performing part of one of the best performing markets was the small companies. And the small company effect works right the way down the range. The smaller the company, on average, the better the return. And you can see there in the dark purple line that actually the very smallest companies, that's the bottom 2% of the market. These are micro caps, say 150 million market cap stocks at the moment, excluding the largest 98%, actually didn't just outperform the small cap market, they greatly outperformed it. And if we have a portfolio which invests not just in the mainstream market, the All Share Index, but the light blue line and the purple line, then we have the opportunity to add value. We think that actually the world's going to be unsettled going forward. We think economics are going to be unsettled. Unfortunately, there may be companies which fail. There may be unemployment. Governments may run out of money. Bond markets may not be quite as stable as they've been in the past. And we think this is just the kind of time when companies generating surplus cash, quoted companies with not too much debt or surplus cash, can take over companies from the receiver, debt-free, and enhance their earnings growth, which would be good for the mainstream companies, but actually can be even more advantageous for small companies. The interesting thing is, in spite of these really quite exciting prospects, at this stage, we haven't really seen the market change in its behavior as yet. What we're showing here is the valuations. On the right-hand side, that's the All Share Index. The All Share Index is standing at a discount valuation relative to perhaps US assets, which have been much more popular. A very substantial discount relative to the NASDAQ or perhaps the Magnificent Seven, the largest 7 technology companies in the US. But most particularly, when you look down the market cap range, you can see the AIM market there, which is also standing on a discount valuation to the mainstream UK. And when you look at the portfolio on the left-hand side, you can see actually the portfolio actually is standing at a slight discount, not just the AIM market, but also the mainstream markets. So we think there's a huge catch-up trade over coming years as valuations normalize. But thereafter, we think then the UK will continue to outperform as that earnings growth accelerates as companies become insolvent and quoted companies in the UK buy assets from the receiver. Good for the mainstream companies, but particularly good for small companies where perhaps some of the greatest earnings growth might come through. And so when you look at the trust actually over the longer term, over the last 5 years, maybe it hasn't produced very exciting returns in capital growth. As I say, we've seen a general pattern where people have been taking money out of the UK market and putting it into the US. That's been unhelpful for the mainstream markets, although they've bought back shares at faster and faster rate, which has tended to mean that their share prices have held up okay. But many of the smaller companies, particularly AIM-listed companies, have actually seen their share prices overwhelmed by local sellers, not enough buyers, and valuations are driven down, even as they continue to be successful in generating income and income growth. So actually, if you look at not so much on the last 5 years, but actually look at since the trust was first set up, what you can see is actually the strategy has been very successful. Even at a time when mainstream companies have done well, even at a time when globalization has been rife, even when equity income strategies haven't been particularly popular, this strategy is the trust has continued to generate not just an attractive, good and growing incomes, but actually a very attractive long-term total return, capital plus income reinvested, which has outpaced most of the peer group and most of the competition. To some extent, this is something which we've been thinking about for quite some time. Those who have followed me will remember that I published a book years ago now, back in 2011, called Slow Finance. And what was interesting about that was, even at that stage, I was worrying a little bit about people investing without perhaps looking under the bonnet. Slow finance really just takes the analogy of slow food. Those people who knew about slow food knew that prior to slow food, people just used to buy food and they never looked at the ingredients. If you bought it from a reputable retailer, it was going to be fine. And then they started looking at the ingredients back in 85 onwards, and they suddenly thought, my goodness, I had no idea that there was this stuff in it. And ultimately, that's led to a big change in the way that we make our food. And that's kind of moment that when people suddenly recognize that actually something which they thought was perfectly good wasn't as good as when they looked on the bonnet, is going to be a feature which we think we're going to see in terms of equity funds as well. So many of the exchange traded funds, some of the index funds, they've done perfectly well. But actually, when you look under the bonnet, you may find actually there's a lot of correlation risk together. They all move together. And actually, many of the individual holdings are very substantial in themselves. And there's an awful lot of stock-specific risk. And when you look at a number of funds, they all have many of the same holdings. So we think it's been replicated many times. And we think there's going to be a moment coming up when people just say, my goodness, I had no idea the nature of what I was actually buying, and I'm going to look under the bonnet. And I think that will actually stimulate more investment into quoted companies, particularly quoted small caps, equity income stocks. And again, I think that's another feature why the trust perhaps has a good opportunity, not just in the short term, but in the medium and long term. So when you look back now at how the trust has done, as I say, last 5 years, maybe the NAV has come up a bit, but it hasn't done particularly well. But what you can see here is since the trust was first set up back in 2011, each year the trust has produced an income. It's paid out to shareholders 4 times a year. It's grown over time. There were some special dividends along the way. But what is interesting is even now, from 2019, when you look at the mainstream companies, the FTSE 100, the FTSE 250, the income paid by these companies fell back in 2020 and has never quite recovered as much as it was in 2019. So it's still behind where it was in 2019. By investing across a wider range of companies through the diverse income trust, with individual companies succeeding, what we've seen is the trust hasn't just maintained its dividend through this stress test. It's actually revenue per share has grown, the earnings per share have now been reflected in dividends per share, and we've seen the trust continue to grow its dividends, even in spite of the fact the main market hasn't grown its income over the last 5 years since 2020. So coming back to it, we think that's the cornerstone of what we're trying to achieve. You get that income even if the market's flatline, but most particularly, we also think there's going to be a pattern change, and UK is going to continue to outperform, and small caps are going to start outperforming as well. And again, another key feature is, many of the companies in the portfolio don't do lots of things for many years. XPS, which is a pension advisory business, as you can see, the share price was flatlining for 2 or 3 years from 2020 onwards. But what was interesting is when it became picked up by some of the analysts, when it had some upgrades coming through, it wasn't just that the share price went up, but actually the more as its share price rose, its market capitalization increased. The more its market capitalization increased, the more the wider number of institutional investors who said, you know what, actually, I hadn't seen this company. It's really quite good. And they drove up. So you didn't just see the earnings growth coming through, but you saw its valuation also improve through this period. And so you get a very attractive return. Now, it's done very well. We've taken some profits on it. We've still got it in the portfolio. It's an excellent company. But most particularly, when we're looking for companies, you can see those green lights. We need companies which are going to generate good surplus cash growth over time. And that comes from the top traffic light, which is good and growing turnover. But specifically along that, we need margins not just to be sustained ultimately, but certainly not falling margins. We need margins to be hopefully rising, but hopefully not falling. Thirdly, we need a management team which has got very feet on the ground. We are uncomfortable with people who are overconfident. We do meet quite a lot of management teams who are overconfident. They take too much risk. We like a safe company, so even if things don't come through as quickly as we like, then hopefully it has a strong balance sheet. This company had relatively modest debt. And most particularly, we like companies which are undervalued. And if we get those green traffic lights, then that's what really builds into the portfolio. We've been putting new holdings in the portfolio. We've been topping up some of our existing holdings. And that is the process by which we select companies. Of course, when it comes to selling, then, of course, one single red light. As I mentioned, this company, it's probably, it's moving away from green on valuation to orange. We've started taking some profits for that reason. So to conclude, I think that the nature is that we've been in a period where, looking backwards, it's been an extraordinary period. Returns have been wonderful for investors. Capital gain has been dominating investor behavior. But what we're seeing now is actually uncertainty. Even as long ago as 2015, we started to see the first seeds of change. We're now seeing them coming through, and we just haven't seen behavior of the markets change very much. But what we are looking for is actually to see not just income becoming interesting, but the UK start outperforming. Since Trump has been inaugurated, the UK market has been one of the best performing markets in the world. We're not surprised, it's undervalued, but most particularly, it's outperforming the S&P 500 and many of the US comparatives. Specifically, we think it's not just about investing in good and growing income. We really want to invest in companies which are wide-ranging, diversified holdings, so that if we get unexpected geopolitical events, hopefully the fund holds up well. Some will disappoint, but some will do better. But most particularly, companies which are less mature, companies which have the opportunity to not just succeed, but thrive, companies where earnings growth could accelerate if things get tougher and companies become insolvent. We think the risk-reward ratio on the trust is the best we've seen for 30 years. Thank you very much indeed.
Thank you, Gervais.
Perfect. Guys, if I may just jump back in there, and Gervais, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Claire, Gervais, as you can see there, we have received a number of questions throughout today's presentation, and thank you to all of those on the call for taking the time to submit their questions. But Claire, at this point, if I may just hand over to you to chair the Q&A with Gervais, and if I look to pick up from you at the end, that'd be great. Thank you.
Thank you, Jake. Okay, yes, thank you for all the questions. Keep them coming in. So first of all, Gervais, does the income progression in small caps in any way represent increased willingness of company management teams to try and appeal to retail investors, given the persistent outflows from UK funds? How aware are corporate management teams in general to the flows challenge to share ratings?
They're very valuable. I mean, the whole point about many small companies is that the valuations weren't good 5 years ago, and their valuations have probably come down in many cases. So actually, they're horribly aware of this. We've seen many companies delist. We've seen companies being taken over. This is a major issue. If anything, far from paying income, many companies will say, well, why should we be paying income? We should be buying back our shares. So if anything, we've seen companies moving from growing their income to actually perhaps growing their income less, or perhaps not paying income and buying back their shares. So that is the general direction of travel. We don't mind companies buying back their shares if they're undervalued, but really we're slightly more interested in the longer term. And we think ultimately building not just a dividend record, but a record which sustains, particularly through 2020 and more recently, we think ultimately we'll actually have the best opportunity of raising capital. And when it comes to taking over insolvent companies, over leveraged but viable businesses from the receiver, it's often not just a case that you can pay £1 for them. It's a very low cost of acquisition, but nearly always you're going to need some working capital. And so actually the opportunity isn't just to buy the company and get a big upgrade, but actually you may need to raise cash. And actually your share price at that stage is going to be very important. So coming back to income and income growth, we think that companies which have got income and income growth will find it easiest to raise capital in uncertain world and actually have the greatest upgrades and the best opportunity to buy assets from the receiver. And so actually we're in a period where we think that actually don't just buy back shares. keep that good and growing income going forward. It demonstrates the strength of the business. Even if you find that your earnings aren't going up, we do encourage companies to increase dividends by 1 or 2%, if only to say, we're not necessarily increasing it much now, but we've got more coming in the future. And we think the unbroken growth record of dividends will become one of the most important features in terms of raising capital. So ultimately, yes, it's a big agenda point. We talk with companies a lot. Specifically, we ask them, don't get taken over, right? So it's lovely to see 50% upside, you might think, but many of these companies could go up 3 or 5 times over a number of years. And the last thing we want to be is give that 3 or 5 times to someone else who pays a 50% premium. We've just seen 2 bids today. It's, we've had H&T in the company in the portfolio. It's been disappointing. We say, please don't even think about telling anyone about takeover. If you've had a takeover approach, say thank you very much. We're not interested, and send them away. But don't tell the public, because by doing so, you only get a question of what the valuation is, and then it gets taken over, and we miss on that 3 or 5 times upside. So coming back to it, this is a live debate, very much so.
And in terms, just a follow-up question or subsidiary question from me, I mean, are you seeing an increasing number of buybacks from companies in your portfolio?
We have seen, the valuations were so low that some people just listened to what we said, and they said, look, I know you're not that keen on buybacks and you want us to grow the dividends, but it's just ridiculous. We've just got to do it. So we have seen, and so that's driven some share prices to recover before UK small caps have really recovered. This year, as you know, the main market's up a little bit, but what's been interesting, particularly in the last few weeks, is we've seen many of the smaller quoted companies outperforming the mainstream market, as we saw back in the 60s and 70s. But more important than that, actually, the best performing market, if you take the last 3 months, it isn't the small cap index or indeed the FTSE 100, but it's actually the AIM market. That's very unusual, and not just that it's undervalued, but actually many of those companies are now in a position where investor interest is just at the very margin increasing. And we need almost no improvement in interest to drive share prices. These are tiny companies, right? So the tiniest bit of interest, not just from UK investors, some international investors as well, some takeovers, of course. So we're just seeing this pattern change, which is pretty exciting.
Okay, and just in terms of the AIM market, you're a big supporter of the AIM market as part of the UK market structure. I think it's its 30th anniversary. I mean, any general comments to make on its future? Yeah,
I mean, if you look backwards, it doesn't look very exciting. So the AIM market is largely missed out. We've had sort of moments of tremendous excitement, .com boom, of course. Back in prior to the crash in 2007, there was an awful lot of early stage mining companies which didn't do that well ultimately. So there's been some mismatches along the way. But many of the companies which are listed on AIM are run in a very conservative manner. They've got strong balance sheets, they've got strong businesses, they're producing good and growing earnings growth. They're growing their businesses quite happily. Premier Miton, I might add, is actually a company listed on the AIM market. So coming back to it, actually, many of these are overlooked. So yes, we think there's we're not looking at where the company's listed. We're looking at the quality of the investment case, and it's that feature which drives it. And sometimes they're mid caps, and sometimes they're small caps on the LSE, but sometimes they're AIM listed companies as well.
Yes. Okay, and we've got a follow-up question, I think, in relation to your takeover point. Would a rejected takeover offer prompt you to look at a non-portfolio stock? I guess you wouldn't necessarily know whether it rejected a takeover based on what you're saying, but
well, I presume. I mean, they wouldn't tell me. I mean, I don't know if it'd be main side, but it's kind of it's that by telling me, they're sort of telling the world. So that wouldn't work very well. But some companies do say in the past they've had takeovers.
Yeah.
And obviously that's quite interesting. If they've got a market position which is sufficiently interesting for other people to want to buy it, that's always helpful. But it's not really going to be the driver of why we sell stock. Ultimately, we look for a company which has these ingredients. I talked about the 5 traffic light process, but most particularly, we want a company which intrinsically has real value, and if it does well, doesn't just succeed, but can succeed in generating abundant surplus cash, and then that drives up the share price considerably. And I'd say, if we get to an uncertain world with a puppet master pulling all the strings and such like, then the opportunity for these companies to actually have accelerating earnings growth at a time when many other companies may have downgrades because of recessions and such like, is going to cause capital to move away from the mega caps into the mid caps, into the small caps. And as I say, the UK market is only 4% of the world. US is probably 2/3 of the world. Yeah. Taking money out of the US has a sort of 15-fold up effect in terms of local companies. And of course, if they go into small caps, then it's even more substantial than that. So even tiny changes here are going to have a big effect. But once we get that pattern change, and I think it may have already started, then actually this could just drive share prices so much further than most people.
Okay, and then another question. Do you have any sort of strict guidelines in terms of the proportions of the portfolio that you allocate to certain sizes of stocks?
No, the key determinant is the investment risk and reward. It's obviously that's a judgmental feature, but most particularly we also look to diversify risk. So we don't want to just have loads of house builders.
Yeah,
it's lovely to have house builders if they're going up. We don't have any house builders in the portfolio at the moment, but we don't want to just replicate the risk again and again and again. So we're quite interested in diversification, which means that when you do get unexpected events, COVID, maybe Russian invasion of Ukraine, whatever it is, then it means, yes, of course, some stocks lose out, but some others don't just survive. They actually have a better opportunity than they ever expected in the invasion of Ukraine. Of course, the energy companies went through the roof, for example. So coming back to it, we've got to have that diversity. I think we're probably more diverse than many other equity income funds, not just because we've got, less reliance on the big companies. We've got a wider range of companies and companies which are in the mining and minerals sector. I think particularly gold sector has been very good over the last 2 years, and many of our gold companies have actually been very helpful in generating not just returns, but good dividend increases as well. But also we've got more interest in some of the slightly more complicated financials. Large financials are on low valuations. Small companies and financials have been very lowly valued. Some of the banks have been crazily valued. I mean, we bought back into a secure trust. We had a holding, a tiny holding left. It's gone up nicely this year, and it's been one of the top performers for the fund this year. It's moved up to a P ratio of 3.2 times for the current year. So kind of it's ridiculous. It's just a wonderful opportunity for investing.
Okay, and then I think final question, perhaps partly one for me to cover as well as you. Are there plans to expand marketing or distribution efforts in light of recent performance and small cap momentum? Well, I guess I would say one thing from this perspective, Gervais is out and about a lot. He's not only sitting at the other end of a camera, but he presents regularly at retail events as well as to professional investors. And it's also worth saying he does a lot in the media. You may, if you get up early, catch him on various radio, television occasionally, a fair amount in the press, and there's quite a lot more to come. So I think we do a fair amount, but Gervais, anything more that you
what's been interesting, I think the board recognised that actually this is a moment to raise the profile.
Yeah.
So the board has actually allocated a little extra cost, not much. This is an example of it. Investor Meet Company, exactly. Right? So this is a new initiative. We've done other things with Directors Talk, but now we're doing this as well. On top of that, actually, we presented at Mello recently.
Yes.
So again, that was again something which the board wanted to do, and we've done that with 80 investors in the room, etc. So yes, but there's lots more to do.
Yes.
It's a great story,
yes.
and it's lovely to see NAV going up. But we really, we want investors to fully participate in that. And actually, in many cases, we think it's a great investment for people who've got investments in other things to actually come into the UK. So absolutely, yes, there's no holding back on that.
Okay, just one more question, actually, that I've just spotted.
Yeah.
Given your multi-cap approach and the small cap valuation discount currently in place, it'd be interesting to know whether you observe any rough tipping point in market cap, cash liquidity of daily turnover, where valuation re-ratings follow, where they come onto the radar of your peers with higher minimum market cap requirements?
Yeah, I mean, there are, and I won't embarrass anyone in this sense, but I'm aware of some small company professionals who are formally banned from investing below a certain market cap range.
Right.
Say 150 million, 100 million. It's kind of strange, really, because they say in the invest in small companies and then they exclude half the investment universe or whatever. Anyway, that's not for me to worry about, right? But coming back to the question, obviously, when you go through 100 million, when you go through 150 million, typically that makes a big difference.
Yeah.
But what I'm expecting to see is, although the main market's going to be fine, mid caps will do probably just fine too. I think the best of the return is going to come down the market cap range in some of the small caps, in some of the AIM stocks, in some of the micro caps. And so what I'm expecting to see is many professional small cap investors to start changing behavior and say, look, I've only got 40 holdings or 40 million in this fund of 800 million or whatever, but actually I'm going to have to kind of have some half holdings. And so I'll have 10 million in this one and 10 million in this one, or indeed quarter holdings, 5 million because many of those are going to be the companies which are generating the income growth. Many of those can generate extraordinary earnings improvement on takeovers and such like. So we're expecting to see this invisible line to start coming down, right? And so as that happens, of course, it'll ease it. But half of the entire listed companies in the UK are below 150 million market cap. We are so lucky to be able to actually just research all these companies, pick out some winners, and then when they do go through this limit, then start to get real momentum, as we saw with XPS.
Okay, so just a couple of closing thoughts.
So I think what I would say is, obviously we don't know about the future. Be careful to be too certain about the future. So let's not be too certain about it. But what we are seeing at the margin is very significant pattern change. Last 30 years, we've seen mainstream companies, particularly mainstream passive strategies, doing really well. That's fine. They may continue to do well. The nightmare is that passive strategies rely on markets going up. We don't know markets are going to go up forever. Look at the Japanese market. It went flatline for 30 years or whatever. So coming back, we think there's a real opportunity for investors to start changing their behavior, reflecting the change in economic circumstances, the change in the political climate. And specifically, this trust, we think, is not just well positioned, but being in the UK, having the broad investment universe, that good and growing income, that excess cash, has the opportunity not just to succeed, but succeed disproportionately.
Thank you very much, Gervais. Jake.
Perfect. Claire, Gervais, thank you very much indeed for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team with the Diverse Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.